So, do you finish? So, you have to do one more question, isn't it? So, which question was that? November 20, June 20. Question number 4, part A. So we can go through, we can now go through the question for June. So June 2013. Question number 4, part A. June 2013. Question number 4, part A. So that's the last question I want us to go through when it comes to replacement. When it comes to replacement, that should be the last question I want us to go through. So when you go through the question reads that Bram Limited has found out that after only 2 years of using a machine, a more advanced model had arrived in the market. The advanced model is expected to increase output. So existing machine had a cost of 32,000 and was being depreciated using the straight line method over the 10 years. It was being depreciated using the straight line method over the 10 years. So current market value of existing machine is 15,000 shillings. Current market value of existing machine was given as 15,000. So Bram Limited is considering acquisition for the advanced model, which will cost 123,500, including installation cost, and has a salvage value of 2,500 at the end of 8 years of its useful life. The following data has been provided. So capacity is given, existing machine and also advanced machine. So you are given also the selling price per unit, production cost per unit, labor, material, fixed overhead allocated, also required rate of return, which had been given as 15%. So you are saying you are meant to ignore taxation. So required, compute the following in respect of the new machine. Roman letter 1, payback period. Roman letter 2, net present value. Roman letter 3, internal rate of return. So first we follow the normal step of how to deal with the payback period. We shall follow the same information on how to compute the payback period. Then after that, we shall now go back and calculate the payback period and also the net present value, then also the internal rate of return. But the question is very clear, we ignore taxation. Once you ignore taxation, it means there will be no capital gain. It has to be ignored. There will be no depreciation in that manner. So we start off with the step number 1. I will start off with the step number 1 to see how we can be able to calculate the incremental cash outflow. Remember the step number 1, you are meant to come up with the incremental cash outflow. So let us see how we can calculate the incremental cash outflow. I want to see how to compute the incremental cash outflow. I want to see how to compute the incremental cash outflow. So to get the incremental cash outflow, there are only 2 items in this question. We start with the initial cost of the new asset or machine. We start off with the initial cost. Initial cost of the new asset. So that initial cost of the new asset was provided, and they gave you in the second paragraph. When you check through the second paragraph, they have said that RAM Limited is considering acquisition of the advanced model, which was to cost 123,500, including the installation cost. So that figure is 123,500. 123,500. So it already includes the installation cost. The question had no changes in the working capital. We just ignore. The question had no overhaul cost. We just ignore. The only item I can see there, we less market value of the existing asset or the old asset. So we need to less market value of the old asset. We less market value of the old asset. We minus the market value for the old asset. Remember, it had been provided to you at the end of the first paragraph. Current market value of the existing machine, they gave us how much? 15. So we simply subtract, then that will be our step number one, because there was no tax. When there is no tax, there is no need of you calculating the capital gain, because we only need the tax on the capital gain. But if there is no tax, you just ignore. So that will be your step number one as per this question. Then they have said there is no tax. When there is no tax, you also accept that there will be no depreciation. So step two is not there. Remember incremental depreciation per annum? There is no need of you going through it because the question has specified there is no tax. When there is no tax, no need of you calculating depreciation, because the purpose of depreciating is to reduce the taxable income. But now that there is no tax, no need of you going through that step. So we got the step number three. We got the step number three, where we get the incremental salvage value. We got the step number three, where we compute incremental salvage value. Got the step number three, where we calculate incremental salvage value. So to get the incremental salvage value, we start with the salvage value of the new asset. The salvage value of the new asset. So salvage value for the new asset, I want you to check in the second paragraph where they say that RAM Limited is considering acquisition of the advanced model, which was to cost 123 and has a salvage value of 20,500. So the salvage value is given as 20,500. So we are supposed to less the minus the salvage value of the old asset. But when you check through the question, it was not provided. When you check through the question, it was not provided. So are you able to see the first paragraph? They only talked about the existing machine had a cost of 32,000 and was being depreciated using the straight line method over the 10 years. So they have not mentioned. So we assume it was zero because it was not given. When it is not given, we assume it is zero. That is now your step number three, because step two was not there. Then step number four, you remember you are calculating incremental annual cash inflows. You want now to get the incremental annual cash inflows. We now go to the incremental annual cash inflows. We now go to incremental annual cash inflows. So to get the incremental annual cash inflows, incremental annual cash inflows. Incremental annual cash inflows. So remember this time we should apply the cash flow statement. We should be able to apply the cash flow statement. So we start with the incremental sales revenue. We start off with incremental sales revenue. We start off with the incremental sales revenue. So what you do, you take the sales of the advanced model, you minus the sales of the existing model. So for the advanced model, you can see 230,000 units. You take 230,000 units multiplied by the selling price per unit, which is 0.95. We subtract the one for the existing. The one for the existing, it is 200,000. It is 200,000 multiplied also by 0.95. So get that figure, get that value, and see it will be able to give us how much? 28,500. So that's now our incremental sales. Then there are some costs, but those costs, if it is incremental cost, you subtract. But if it is savings in the cost, we add. Yeah, there are some costs there. So if these are savings in the cost, we normally add. But if it is an incremental cost, we less. So the first item there, you can mostly we normally start with the material. We normally start with material. So we need to know whether there is savings on the material or incremental cost on the material. So what I would like you to do, I want you to take the one for the existing. You see the 200,000 multiplied by 0.48. I want to confirm material. Multiply 0.48. Then also compare that with the one for the advanced model. 230,000 multiply 0.46. And check which one is more. And confirm which one is more. Is it the existing machine or the advanced machine? Advanced has more. Yeah, so if the advanced, is it? Advanced has more. So if the advanced has more, it means it is incremental material cost. So we less incremental material cost. So we less incremental material. So what you do, start with the advanced, because it's the one with more, isn't it? So take 230,000 multiplied by 0.46. 0.46. We subtract the 200,000 multiplied by 0.48. So that should be able to give us what is supposed to be the incremental material cost. So we are subtracting the figure. 9,800. So that figure is then confirm LEPA. Confirm LEPA whether it is a savings or incremental LEPA cost. Confirm LEPA whether it is a savings. So just compare which one is more. Existing has more. Yeah, so that needs to be savings on the labor cost, because when you change, it is less, isn't it? Yeah, so we add savings on the labor costs. We add savings on the labor costs. We add the savings on labor costs. So I start with the existing because the one with more. So you take 200,000 multiplied by, so it is 0.12. You minus, this is 230,000, but now we multiply it by 0.08. So we get the savings on labor. So when it is savings, we normally add. How much will be that savings? Sorry. So 56. The next one is supposed to be the fixed overhead. So also confirm whether it is a savings or incremental. Confirm whether it is a savings or incremental. It a savings or incremental? Yeah, so we also add savings on the fixed cost. Savings on the fixed cost. So if it is savings, start with the existing, which is 200,000, multiplied by 0.25. We subtract 230 multiplied by 0.16. 0.16. So get the total. There was no depreciation, so that now will be able to give you the incremental annual cash inflows. That will be able to give you the incremental annual cash inflows. So normally we go to the step number 5, incremental terminal benefits. We need to get the incremental terminal benefits. We should now come up with the incremental terminal benefits. So we need to get the incremental terminal benefits. We need to come up with the incremental terminal benefit. But now this one, we just take the incremental salvage value. We just take the incremental salvage value. So we know it was 2,500. So there was no changes in the working capital. We are supposed to add the changes in the working capital. So there is no value for us. We just have 13. So after those workings, now we go to the Roman letter 1. Roman letter 1, they would like you to calculate the payback period. So this time around, it is not a discounted payback period. It's just a normal payback period. So it is not a discounted payback period. It is simply a normal payback period. So to calculate the payback period, when you want to compute the payback period, when you want to calculate the payback period, so payback period, when the cash flows are the same, to get the payback period. So to compute the payback period, we simply take the present value for the cash outflow, we divide by the annuity. That is only when cash flows are the same. So you simply take present value for the cash outflow, divide by the annuity. So present value for the cash outflow is what was there in step number 1. We calculated step 1, we got how much? 108. Then annuity is the annual cash inflows. We calculated annual cash inflows. Sorry? 37,500. So that now will give you the payback period. Now give you the payback period. So how many years are those? Sorry? 2.89. Yeah, so that's now our payback period. That will be our payback period. So I've used this formula. It only applies when the cash flows are the same every year. Yeah, otherwise you could have separated them. The other way we use equations. But this one, the cash flows are the same for the 8 years. So the next one is the net present value. The next one should be the net present value. So NPV is supposed to be given by present value for the cash inflows. We minus the present value for the cash outflows. So NPV is supposed to be given by present value for the cash inflows. We minus the present value for the cash outflows. So we start with present value of the cash inflows. So to get the present value for the cash inflows, the first one will be annuity multiplied by present value interest factor for the annuity. We multiply by present value interest factor for the annuity. Cost of capital is the required rate of return, was given as 15% for 8 years. For 8 years, because you can see in the first paragraph, they say that Brand Limited has found out that after only 2 years of using the machine, a more advanced model had arrived in the market. The advanced model is expected to increase the output. The existing machine, so it was being depreciated using the straight line method over the 10 years. So when you got the next paragraph, they are saying that Brand Limited is considering acquisition of advanced model, which was meant to cost 123,500, including installation cost, and has a salvage value of that at the end of how many years? 8 years. Remember, I had told you that the remaining economic life of the existing machine must be the same as economic life of the new machine, even if it is not given. So my annuity is the 37,500. My annuity is the 37,500. Then I would like you to confirm from the table. You confirm from the second table. What will be 15% in year 8? That should be 15% in period 8. Sorry? 4.48. Then there was also the terminal benefit. There is also the terminal benefit. So terminal benefit normally occur only once. So we use the first table, whereby it is 15% in year 8. So terminal benefit, we have calculated about 20,500. It was 20,500. So I want you to use now the first table, because it will only occur once. So in the first table, It is 0.1. Yeah, so when you add those two figures together, that is what will give you present value for the cash inflows. Then you less present value for the cash outflows, which was 108,500, which was 108,500 to get NPV 108,500 to get NPV. So that we come up with the NPV.
Next, the information says that machine cost and semi-market.
So that is now our Roman letter to net present value. That now will be our Roman letter to how to compute the net present value. So once you get the net present value, we also got the Roman letter 3. Roman letter 3 is the IRR. So Roman letter 3 will be IRR. Roman letter 3, we should be having it as I. So when it comes to the IRR, because of the terminal benefit, we shall be using the formula of the unequal cash flows, the trial and the error method, because of this terminal benefit. So we said that we get NPV using the cost of capital given, which is now this step. We have already calculated NPV. So we recalculate again NPV to get a negative. So to get a negative, we normally use a higher value. To get a negative, we use a higher value. So this one we have used 20%, 15%. So we need a higher one. So I gave you a rule that we double, isn't it? So if we double, we get 20%. So can you confirm in the table whether there is 30%? It is. Yeah, but I know 30% is likely to give you still a positive figure. But it will still give you the correct answer. So I just want you to use 30% because that is what we normally follow. But even if it is positive, we just require two figures. So apply 30% and get now the new value and get the new NPV. Just repeat the entire process. But now use 30% and get the new NPV. Then we get the new NPV. And if it remains positive, don't bother. You can just continue and use the formula. We shall get the correct IRR. We shall be coming up with the correct IRR. So when you want to get the IRR, so IRR is supposed to be given by lower discount rate, NPV of the lower discount rate. We divide again NPV of the lower discount rate minus NPV of the higher discount rate. Then higher discount rate minus lower discount rate. So lower discounting rate was the 15%. Just confirm for me, what was the NPV when it was 15%? Sorry?
66,573.
66.
573.
So you can just have it as 573. We round it off. Even this one, I know it is still positive, isn't it? Yeah, even if it is still positive, because we just want two figures. Yeah, so we also divide again by, if it's 66, 573. Are you in a positive watch? No, I've calculated the one for 30%.
That's 89.
36.
89.
30 minus. You just come up with those values. So that's now the question I want us to try, because of the nature of the information given, to see whether it will be able to add some value for that. So that is now the conclusion of the replacement analysis. I gave you the notes for the evaluation. Your parents, the valuation of securities. So online, our next topic should be valuation of securities and the business. So I want us to go through that. Before then, those who are going for the prayers, we can have a short break for the prayers before we start a new topic.
So when you have that, if at least you decide to make yourself
Alafu aje nitapata final answer tunapata the same thing.
The higher discounting rate, the lower discounting rate. It's not 27.5. The lower discounting rate is the lower one or the higher that on the lower one was what? 16%. Such not reaching the for the same thing. 90 is proportional case. 60 is proportional case. That's why you was 60 come up 570. Illegal bubble. No, I'm talking of the lower NPV. Lower NPV is straight, I think 66%. The lower one, at the high 36, 89. 89, 36, 89. That's a very happy. Yeah. So the very next is 168. So I'm looking at different. Distraction. Anatafuta mtu hata sisi tulifanya hivyo kitabu tukipanisikia tulikuwa tunaenda kwa pamoja tunataka ni kwangu itaisha tuki sijui nani ndio tutapata ni amri ikipata mtu Where? I want you to say, as noted, it should be it is been really more than a bit of a case. Monday, after Tuesday, what do you have in the case? Tuesday. Chicken say and making manager.
So we now start a new topic as valuation of business and the securities. Valuation of business and securities. So I've given you the notes for the valuation. I've given you the notes for the valuation. I hope you can see the notes. I gave you the notes for the valuation. I gave you the notes for the valuation. Valuation of securities and business. Watu wangapi wako kwa class? So online, I hope you have seen the notes. We now start a new topic which is all about valuation of securities and business. So when it comes to valuation of security and business, there is information on the first page where they say that valuation is the process of determining the worth of the security or business. So valuation is carried out in the market by financial experts, and the value attached to the security is known as the theoretical value or intrinsic value. So that's now what we mean by the value of the security. Then down there, when you check, I've given the reasons for valuation of the securities. I've given you the reasons for valuation of the securities. So I would like you to refer to one of the questions in relation to that. May 2021, question 1, part C. I would like you to check May 2021. May 2021, there is a question number 1, part C. May 2021, there is a question number 1, part C. May 2021, there is a question number 1, part C. So when you check through May 2021, May 2021, check May 2021. There is a question number, sorry, question 1, part C. May 2021, there is a question number 1, part C. So that question 1, part C, you can see the Roman letter 1, where they have asked you to describe 4 reasons for valuing the financial assets. They would like you to describe 4 reasons for valuing the financial assets. 4 reasons for valuing the financial assets. So, are there notes about valuation in the class group? I had sent those notes some time back, and then in my last class, I said you make sure that you have those notes today so that we discuss them. So those who are online, can you access the notes in the class group? Yeah, so those notes were sent long time. Then in my last class, I asked everyone to print those notes. Don't leave them as a soft copy. It is important for you to have them as a hard copy. It will be easier for you to revise. So that question 1, part C, Roman letter 1, that Roman letter 1, part C, they are asking you to describe 4 reasons for valuing the financial assets. The question is May 2021, question 1, part C. So May 2021, question 1, part C. So our securities are what we refer to as the financial assets. Securities are what we refer to as the financial assets. So there are 7 of them. There are 7 of them who are meant to discuss each. There are 7 of them who are meant to discuss each. So that's now all in relation to that part of the question. I would also like you to check the one for September 2021. September 2021. September 2021, question number 4, part A. I want you to check something brief. September 2021, question number 4, part A. So September 2021, question number 4, part A. September 2021, question 4, part A. They were asking to summarize 4 features of the efficient market hypothesis. So I want you to go to page 2. I want you to go to page 2. There is somewhere there I've indicated there the efficient market hypothesis. The efficient market hypothesis, whereby it states that information, whether good or bad, once released to the market, it is weekly reflected in the security prices. So should the company release good news, like now declaring high dividends, it will lead to increase in the security price. But if you give out bad news, like now, it will lead to the decline in the security price. That's what we mean by efficient market hypothesis. Once information is given out, it is immediately reflected in the security price of the company. So I've given that an efficient capital market has the following characteristics. So those characteristics are the features or assumptions. Those characteristics are the features or the assumptions, whereby number one is that information, whether good or bad, it is quickly reflected in the security prices. Number two, the security price should be randomly determined. So you go through them in that order. Then apart also from that question, I would also like you to check. There is also a question for May 2017, question 5, part B. I would also like you to change the question. May 2017, there is a question number 5, part B. I want you to check May 2017. May 2017, question number 5, part B. So when you check through May 2017, question 5, part B, is the same. Summarize 4 assumptions of the efficient market hypothesis. They are the same thing that we have seen as the features. Then another question, also go to November 2015. November 2015, question number 1, part B. November 2015, there is a question number 1, part B. I want us now to go to, so November is closer to December 2014. When you go to December 2014, you will get November 2015. So question number 1, part B. Question 1, part B. Question number 1, part B, where they ask you to explain the following theories in relation to the valuation of the financial assets. So number 1 is the fundamental theory. Number 2 is the random walk theory. So you read them, you start from page 1. Page 1, I've given you the theories of valuation. There are basically 3 theories of valuation. Number 1 is the fundamental theory, technical theory, and random walk theory. So I would like you to read through those notes because they are examinable. Then apart from that question, I also want us to check another question. This one is April 2022. April 2022. There is a question number 1, part C. April 2022. There is a question number 1, part C, where they ask you to explain 3 forms of market information efficiency as stipulated by Eugene Firm's efficient market hypothesis. So there are 3 forms of market efficiency. I want you to go to page 3. They are indicated there. They are indicated in page 3. Are you able to see that page 3 where they said that after the price efficiency down there, they have said that the hypothesis of efficient market derives from this last form of efficiency and can be stated as, in the efficient market, prices of the securities fully and fairly reflect all the available information. So Robert suggested that capital market will be efficient at one or more of the three levels. So this includes, so number one is the strong form market efficiency. Number two is the semi-strong form market efficiency, and also the weak form market efficiency. So I would like you to read that handout. We may not get enough time to discuss each one of them, but just go through them. They can give you some information which can assist you to answer the theory questions. So I said theory will give you between 32 and 38%. So make sure that you go through the notes for the theory that I'm giving you, because just get some general knowledge about them. So today I want us now to have a subtopic. So the theory, I'm simply highlighting those questions so that you can get interest to read them because they are examinable. So let us now have a subtopic, because you write the topic as valuation of business and securities in your exercise book. So in your exercise book, you write the topic valuation of business and securities. Valuation of the business and securities. So still under that, we can also have a subtopic as valuation of securities. We can now have a subtopic as valuation of securities. Valuation of securities. So under the valuation of the securities, we shall first summarize that securities are financial assets. Securities are financial assets. Securities are financial assets which are classified into two categories. Securities are financial assets which are classified into two categories. Number one will be variable return securities. Number one will be variable return securities. The number two will be fixed return securities. Number two will be the fixed return securities. So we start with valuation of the variable return securities. We start with valuation of the variable return securities. Valuation of the variable return securities. So under that, we shall be able to summarize that these are securities. These are securities whose returns. These are securities whose returns are whose returns keeps on changing. Whose returns keeps on changing. Whose returns keeps on changing. And in this case, it will apply to valuation of the ordinary shares. It will apply to the valuation of the ordinary shares. Will apply to the valuation of the ordinary shares. Whose returns are in the form of dividends. Whose returns are in the form of dividends. Whose returns are in the form of dividends. So let us have a brief subtopic there as valuation of the ordinary shares. We can now have a brief subtopic there as valuation of the ordinary shares. Valuation of the ordinary shares. So under that, we note that ordinary shares are classified into three categories. Ordinary shares are classified into three categories. The ordinary shares are classified into three categories for the purpose of valuation. They are classified into three categories for the purpose of valuation as follows. They are classified into three categories for the purpose of valuation as follows. So A would be constant dividend. constant dividend growth rate ordinary shares. A will be constant dividend growth rate ordinary shares. A will be constant dividend growth rate ordinary shares. Then B will be non-constant dividend growth rate ordinary shares. Non-constant dividend growth rate ordinary shares. Non-constant dividend growth rate ordinary shares. And finally C will be zero dividend. Zero dividend growth rate ordinary shares. So let us start with the first one, which is constant dividend growth rate ordinary shares. We start with the first one as constant dividend growth rate ordinary shares. The constant dividend growth rate ordinary share. So under that, we say that the value of the security, in this case, the value of the security in this case will be equal to the value of the security in this case will be equal to the present value will be equal to the present value of all the future benefits will be equal to the present value of all the future benefits. It will be equal to the present value of all the future benefits to be realized from the security. The present value of all the future benefits to be realized from the security. To be realized from the security. To be realized from the security. And its value will be expressed as follows. And its value will be expressed as follows. And its value will be expressed as follows. So we are saying that and its value will be expressed as follows. And its value will be expressed as follows. So when you want to get the value of the security, when you want now to get the value of the security, so to calculate the value of the security. So to compute the value of the security, we shall be using PO. So PO will now be the value of the security will be equal to DO 1 plus G. Then we divide by KE. minus G. I will be explaining what each one of them stands for. So this will be the same as D1 divided by KE minus G, like that. So now to get the value of the security, our PO will be referring to the current market price per share. So that PO will be the current value of the share. Our PO is the current value of the share. Then DO is the last dividend per share. DO is the last dividend per share. DO is the last dividend per share paid. The last dividend per share paid. Then D1 is the next dividend per share to be paid. D1 is the next dividend per share to be paid. D1 is the next dividend per share to be paid. Then KE is the cost of the ordinary share. KE is the cost of the ordinary share. Then G is the constant dividend growth rate. G is the constant dividend growth rate. G is meant to be the constant dividend growth rate. Then another paragraph, we can note that there are normally two methods. There are normally two methods of computing. There are normally two methods of computing the constant growth rate as follows. There are normally two methods of computing the constant growth rate as follows. There are normally two methods of computing the constant growth rate as follows. There are normally two methods of computing the constant growth rate as follows. The constant growth rate as follows. So Roman letter one will be retention ratio method. Roman letter one will be the retention ratio method. Roman letter one being retention ratio method, the retention ratio method. So for this one, to calculate G, it will be R multiplied by. So just like that, I will be able to explain what each one of them means. So G will be equal to R multiplied by. So this one is retention ratio of the profit. This one is the retention ratio of the profit. Retention ratio of the profit. Then this one is return on equity. This one is return on equity. This one is the return on equity. Return on equity. So that's now how to get the growth rate when we use the retention ratio method. Then the second formula will be the compounding method. Compounding method. Compounding method. The second formula should be the compounding method. So for the compounding method, you summarize that under this method, the constant growth rate under this method, the constant growth rate will be calculated. Under this method, the constant growth rate will be calculated by comparing the dividend per share between two periods. By comparing the dividend per share between two periods. By comparing the dividend per share between two periods. as follows. Dividend per share between two periods as follows. Between two periods as follows. So to calculate G, it will be N, then Dn divided by Do. Then we subtract 1 like that. So G will be equal to N in brackets Dn divided by Do. Then we minus 1. So I will be explaining them in details when we get a question in relation to that. I will be able to explain them in details when we do a comprehensive question. So just have the formula. When I do a question, I will be able to explain them in details for each method. So I'm looking for some questions which has those details. I'm looking for some questions which have got those details so that we can be able to apply them. In a comprehensive way. So one of the questions I want us to start with should be May 2021. We can start with a question for May 2021, question 1, part C. May 2021, question number 1, part C. We can start with the question for May 2021, question number 1, part C. We can start with the question for May 2021, question number 1, part C. Question number 1, part C, Roman letter 2. Question number 1, part C, Roman letter 2. We can check the question for the sitting of May 2021, question number 1, part C, Roman letter 2. Question 1, part C, Roman letter 2. So that question 1, part C, Roman letter 2, the question number 1, part C, Roman letter 2. The one for Hans Limited expect to pay dividend of 5.40 per share in 1 year's time. They expect to pay dividend per share of 5.4 per share in 1 year's time. Then additional information, they have said that not one, the company's dividend payout ratio is 60%. The company's dividend payout ratio is 60%. Not number 2, shareholders required rate of return on equity is 15%. So dividend have been growing at a constant rate in perpetuity. So the company shares are currently trading at the Securities Exchange at 64.5 per share at the Securities Exchange. 64.5 per share at the Securities Exchange. So now required is that advise the investor who holds shares in Hans Limited whether to buy more shares or to sell the shares. Whether to buy more shares or to sell the shares. So what we need to do in that question, you want to get the value of the share. You want to get the value of the share. So to get the value of that share, we need to calculate. What is meant to be the constant growth rate. So to get the growth rate, we shall be using the retention ratio. To calculate the growth rate, we use the retention ratio. So to get the constant growth rate using the retention ratio, it is supposed to be given by R multiplied by return on equity. It is supposed to be given by R multiplied by the return on equity. R is the retention ratio. when you check through the question in the note number 1, they gave you the company's dividend payout ratio is what percent? 60%. So if they pay out dividend at 60%, it means they retain what percent? They retain 40%. So it is a proportion. You see, 60 plus 40, they add up to 100, isn't it? 60 plus 40, they add up to 100. So retention ratio is 40% over 100. So 40% of over 100 is the same as 0.4. It acquires 0.4, isn't it? Yeah, because they are adding up to 100. Dividend payout ratio is 60%. It means the retention ratio is 14%. So 60 plus 40 add up to 100. So our retention ratio will be 40 over 100, isn't it? Which is going to be 0.4. So return on equity was given in the note number 2. Shareholders required rate of return on equity. They gave us what percent? 15%. So get 0.4 or 15%. That should be able to give us the growth rate. It will be able to give us the growth rate, which is going to be what percent? Exactly 6. Yeah, so it is giving us 6%. So we want to get the value of the share. Value of the share is PO. So it is PO in the brackets of 1 plus G. Divide by KE minus G, like that. So it is the same as D1 divided by KE minus G, like that. So we have explained that DO is the last dividend that was paid. D1 is the next dividend to be paid. D1 is meant to be the next dividend to be paid. So in that question, they have given you the next dividend to be paid. In that question, they have given you the next dividend to be paid. So are you able to see in the first paragraph? Are you able to see in the first paragraph what is supposed to be? You see, the company expects to pay a dividend of how much? 5.40 per share in 1 year's time. So in 1 year's time, they have given us D1 because D1 is the next dividend to be paid. D1 is meant to be the next dividend to be paid. The D1 is meant to be the next dividend to be paid. So the question has given you D1. It is given as which figure? Yeah, so tumepewa 5.40. So the question has not given us DO. We say that DO is the last dividend to be paid, isn't it? But D1 is what? Next dividend to be paid. So the question has given us D1 in the first paragraph that ISA Limited expect to pay a dividend of 5.4 per share in 1 year's time. 1 year's time will be the next to being paid. So they have given us 5.4. So KE, I said it is the cost of equity. KE, I said it is what? Cost of equity. So that cost of equity will be the same as the required rate of return on equity. Will be the same as the required rate of return on equity. Our required rate of return on equity in the note number 2. You can see it is what percent? 15%. So 15% is the same as 0.15. It's the same as 0.15. Then we minus G. G we have just calculated, we got 6%. So 6% is the same as 0.06. Is the same as 0.06. So that we come up with what is supposed to be the value of that share, the value for the share. So how much will be the value of that share? How much will be the value of that particular share? So I've seen it is 60, isn't it? So I've been given a price of 60. You get a price of 60. Then I want you to confirm in the note number 4. I want you to confirm in the note 4. Note 4, they have said that market price per share. The company shares are currently trading at how much in the Securities Exchange? 64.50. So I want us to go back to your notes. I want you to clarify some information there. I want us to go back to your notes for clarification of some information. So in the first paragraph, I want you to check in your notes in the first paragraph. In that particular first paragraph, I want you to go to the line number after where they said that, where they said the market price of the security is determined by what? Forces of demand and supply. Forces of demand and supply. Then they continued that if the market price of the security, is less than the theoretical value, you see that? If the market price of the security is less than the theoretical value, then the security is said to be what? Undervalued. The security is said to be undervalued by the market forces. But if market price of the security is greater than the theoretical value of the security, if the market price of the security is greater than the theoretical value of the security, then the security is said to be what? Overvalued by the market forces. However, if the theoretical value of the security is equal to the market value for the security, then the security is said to be correctly valued. You get that point? So this one, market price of the security is 64.5. But the theoretical value is what we have calculated. It is how much? It is 60. So this security is overvalued by the market forces. So this one, we conclude that the security is overvalued by the market forces because the market has quoted 64.5. But the theoretical value is what? It is 60. So because it is overvalued, you sell the security. When the security is overvalued by the market forces, you sell. So the comment there is that the security is overvalued by the market forces and therefore sell the share. Therefore sell the share, because the question was asking you that advise the investor who hold the shares in his limited on whether to buy more shares or to sell. Because in the stock market, the share is selling at 64.5. But the true value of the share is how much? It is 60. So the best option is to do what? To sell, because you will make a profit or a gain of 4.5. You will make a profit or a gain of 4.5. That's now on that question, the advice. That is now on that question, the advice. Then another question I would also like us to check. Another question I would also like us to check. So the next question. The next question will be, so our next question I want us to go through. So the next question I want us to go through is the one for the sitting of November 2018. November 2018. Let us go through the question for November 2018. Question number 2, part C. November 2018. Question number 2, part C. November 2018. Question number 2, part C. We go through the question for November 2018. There is a question number 2, part C. November 2018. Question number 2, part C. November 2018. Question number 2, part C. November 2018. Question number 2, part C. That question 2, part C for November 2018. Question 2, part C for November 2018. They are saying that earning per share and dividend per share for Maraba Limited over the last 5 years. Over the last 5 years are provided below. You can see the year 2013, 2014, 2015, 2016, and also 2017. So there is dividend per share and also earning per share. There is dividend per share and also earning per share. So additional information, not number 1. Additional information, not number 1. A prospective investor is considering. A prospective investor is considering buying shares of this company, which are currently selling at least 55 each at the Securities Exchange. At the Securities Exchange, the investors' required rate of return is 20%. So required, they wanted you to advise the investor on whether to buy the shares of Maraba Limited using which model? The Gordon's valuation model, using the Gordon model. So Gordon model, I want you to go to the handout. I want you to go to the handout on page. I want you to go to page 10. It starts from page 9. I want you to check from page 9. I want you to check from page 9. Are you able to see page 9? Where they have given you something about E. You can see that particular E. So E, they have said that dividend yield or Gordon's what? Valuation model. So Gordon valuation model, they say this method uses the fundamental theory. It uses the fundamental theory in the valuation of the ordinary share. So in this case, the intrinsic or theoretical value of the ordinary share is equal to present value of all expected future benefits to be realized from what? The ordinary share. Then they have continued to say that this method is usually used by investors who are interested in what? In the dividends, because they cannot influence the management and control during the annual general meeting. So for the purpose of valuing ordinary shares, Gordon classified ordinary shares into 3 categories as shown in the diagram below. So you can see non-constant dividend growth ordinary share, also the constant what? Dividend growth rate ordinary share, and also zero. So it is simply what we are discussing. You see what we are discussing? We have said that ordinary share is classified into 3 categories. Into 3 categories: constant dividend growth rate, non-constant, and zero dividend. So it is what we are discussing. What we are discussing here is the Gordon. So in this question, also to get the value of the share, we shall simply be saying that the value of the share, PO is supposed to be equal to DO in the brackets of 1 plus G divided by KE minus G, So to compute G, we use the compounding method. To calculate G, now we are using compounding method. So when we are using the compounding method, to calculate G, so G is supposed to be given by N, so Dn divided by DO, then we subtract 1 like that. So to calculate G, it will be equal to N Dn divided by DO, then we minus 1. At that question. So I want us to go to the question. So 2013, I want you to name it as DO. So 2013, name it as DO. 2014, it is D1. 2015, D2. 2016, D3. 2017 will be what? D4. So as per the information given, our N is 4. Then D4 divided by D4, we minus 1 like that. So as per the arrangement, because the first one is always period 0. Then D1, D2, D3, and D4. So that means N will be 4. So G should be equal to 4. So D4 is the dividend per share in the year 2017. D4 is the dividend per share in the year 2017, whereby the question had given us which figure? 1.8. You can see 1.80. We divide by DO is the dividend per share in the year 2013. You can see 2013, they gave us dividend per share of how much? 1.0 like that. Then we minus 1. So let us get that G. We had used that formula before. So let us get G at that portion. We can get G at that level. We can be able to compute G at that portion. So we should be able to calculate G at that portion. So what should be our G? Because finally, we shall be able to express it as a percentage. Finally, we should be able to express that as a percentage. Now someone has given me 15%. Someone else is giving 16%. So which is the correct one? But before you round off, you are getting which figure? 15 points. 15.83. Yeah, we want to understand that part. Yeah, so pengine mnapata ngapi? Before, so it is 15.83, isn't it? Are we getting that figure? If you are not sure, you let us know to assist you, because yeah, someone else has gotten 3.58. That is not correct. The correct figure should be 15.8. The correct figure should be 15.83. So those who are not getting the correct figure, now computer from the calculator, what do? You start with the what? You take 1.8 divided by 1, isn't it? Get the answer. Get the answer. After getting the answer, you are pressing which side? You press 4, then shift, isn't it? Then get the answer, isn't it? Yeah, kuna hiyo shift, then kuna hiyo side, isn't it? Kuna hiyo. Then after that, answer. So online, those who say they did not get the correct figure, are you following that? Those who are not getting using the formula, we are saying that you start with 1.8 divided by 1, isn't it? You press the answer. After pressing the answer, I'm told you shift, isn't it? Yeah, there is 4. You press 4, isn't it? After pressing 4, then you shift. After shifting, you press this one, isn't it? Then get the answer, which is 0.158, isn't it? Yeah. So are we okay up to that point? Those who say they were, then you minus 1, isn't it? After you minus 1 is when you get 15.83 as a percentage. So are you all okay up to that point? Wale muko online, is everyone comfortable now at that point? If there is any, so all of them, they are saying they are comfortable. So after getting G, we now go back to compute the value of the share. You want now to go back to get the value of the share. So to get the value of the share, so to get the value of the share, it is that BO is supposed to be given by DO 1 plus G, we divide by KE minus G. Then this one is the same as D1 divided by KE minus G. So I want you to understand here. We said that DO is the last dividend that was paid. So D1 will be the next dividend to be paid. So the question has given you the pattern for the last 5 years. The pattern for the last 5 years. So when you go through the question, they say that the earning per share and the dividend per share data for Maraba Limited over the last 5 years are provided. So over the last 5 years, 2017 is the last period. 2017 is the last period. The next period will be 2018. I want you to understand that part. My D1 here is not the same as D1 of calculating G. Get that part. We have said that the value of the share is the present value of the future benefit. So our DO is the last dividend that was paid. The last dividend was paid is in the year 2017. The last dividend that was paid was in the year 2017. So D1 will be 2018. I want you people to understand that when we are calculating G, we use the past. When we are calculating the value, we go to where? The future. So my DO will be the last dividend that was paid. Last dividend was paid in the year 2017. Next dividend will be paid in the year 2018. So when now it comes to this point, know that our DO is now 1.80. Our DO is now 1.80. Then 1 plus G. G is the 15.83, isn't it? Which is the same as 0.1583, like that. Then KE is the cost of capital. Go to the note number 2. Note 2, they have stated that investors' required rate of return, it is what percent? 20%. So 20% is the same as 0.2. Also subtract 0.1583, so that we now get the value of the share. So that we now get the value of the share. We get the value of the share. So that we get the value of the share. So what should be our value for the share? Get the value of the share. So what should be now the value of the share? Anyone who has completed? So I've seen 50 from online. 50 when we round off, but it is 50 point what? 49.9. So anyway, we can give it 50 like that. So we are comparing with where the question says that a prospective investor is considering buying the shares of this company, which are currently selling at how much in the Securities Exchange? So market price per share is 55. So that share has been overvalued by the market forces. So the share is overvalued by the market forces, and therefore the investor should not buy the share. The investor is overvalued by the market forces, and therefore the investor should not buy the share, and therefore the investor should not buy the share. The share has been overvalued by the market forces, and therefore the investor should not buy the share. So that is now on that question. So when we meet next, we shall go through the question for November 2019. Question 3, part C. November 2019, question number 3, part C. November 2019, question 3, part C. So we can stop there for today. So the topics that we are dealing with from now onwards, they are critical. Make sure that you make attempts to see what we shall be going through in that portion. So let us stop there for today. We can now stop there for today. Yeah, Hassan, you are asking a question. Yeah, Hossein, you are asking a question. So the recording cannot be shared today. It will be shared tomorrow after it has been converted. So we cannot share today, but you will get it tomorrow. The handout, someone to share the handout to the class group, please. Anyone who has it, will share it.